Welcome back to the Microlearning Institute. In this tutorial we look at question number 5, RAVAR, from the November 2013 AIA Paper 13 examination. Firstly, let's look at the calculation of goodwill in Crow. As the net assets of Crow are denominated in zlotys, we calculate the goodwill in zlotys. So to calculate the goodwill, firstly we have to determine what was the cost of Crow. And we're told in the question that RAVAR paid $14.4 million for Crow, and we're given the date at which this occurred. And on that date, the exchange rate was 4.51. So consequently, the group share of Crow was acquired for a sum of 64.5 million zlotys. We're also given an indication of the non-controlling interest at fair value, and at the date of acquisition, the non-controlling interest in Crow was fair valued at $20.75 million. We now need to compare what the cost of each of those elements was with respect to the share of the fair value of the net assets that were acquired. For the group acquired 75% of the net assets. Now, the net assets at the date of acquisition were made up of the ordinary share capital and reserves. If we look at the statement of financial position for Crow, we see the ordinary share capital was 23 million zlotys, and we're told in the question that the reserves at acquisition of Crow were 49 million zlotys. So 75% of the sum of these equates to $54 million. The non-controlling interest was, and there's a typo here, 25% of the net assets of Crow, and that was $18 million. So therefore, the goodwill that was recognized on acquisition within the group was 10.5 million zlotys, and the goodwill that was recognized in the non-controlling interest was 2.75 million zlotys. And the total goodwill in that case in zlotys was 13.25 million zlotys. Now we need to translate that goodwill at each year end. As the goodwill is an asset of the group, it must be translated at the closing rate at each year end in line with IAS 21. So we see that at acquisition on the 31st of October 2013, the goodwill that we've just calculated at $13.24 million is translated at the rate that was applicable on that date, which was 4.51, and that equates to $2.93 million. 1 year later, again, there was no impairment of goodwill, so the same amount of goodwill in zlotys was attached to the subsidiary Crow in zlotys, but the exchange rate had moved to 4.26, so consequently when we translated the goodwill to dollars, it translated to $3.11 million. And that's recognized as a gain on translation of goodwill of the difference between 2.93 and 3.11, which is $0.18 million. Again, on the 30th of October 2012, the goodwill is still the same, 13.24 million zlotys. However, the exchange rate again has changed to 4.05 units, and in dollars we now have $3.26 million in goodwill translated from zlotys. And again, the incremental gain in that year is 0.15. And finally, in the year ended the 31st of October 2013, again we translate the 13.24 million zlotys at the closing rate of 3.75 now. And this translates to $3.53 million, again another incremental gain within the year of $0.27 million. So the total gain on translation of goodwill since acquisition is $0.6 million. Next, we translate the net assets of Crow. Now, again, the net assets of Crow are prepared in zlotys, and again we can see from the balance sheet that the ordinary share capital and retained earnings at the 31st of October 2013 is 262 million zlotys. We're told that dividends had already been paid and that the profit in the period from the P&L comes in at 154 million zlotys. So therefore we can conclude that the opening net assets of Crow was 172 million zlotys. If we translate the opening assets at the opening rate, And if we add that to the translation of profit at the average rate, and if we translate the dividends at the rate that was applicable on the date on which the dividends were paid, then each of those individual items translates to a particular value in dollars. However, when we translate the closing net assets at the closing rate of 3.75, we see that we make an exchange gain on translation of the net assets of 3.05. Next up, we translate the statement of financial position. Again, we're given the statement of financial position in zlotys, and again, for reference here, I've split out the pre-acquisition reserves, which we were told were 49, from the post-acquisition reserves, which were 190, and of course 190 plus 49 equals the retained earnings on the statement of financial position in the question of 239. So we translate the total assets at the closing rate of 3.75, giving us $89.6 million. The ordinary share capital is translated at the rate that was in place when the ordinary share capital was generated, and of course that was the date of acquisition. Similarly, the pre-acquisition reserves are also translated at the acquisition date rate, whereas the liabilities are translated at the closing rate. Now, as all of these must add up to $89.6 million to balance our balance sheet, we take a balancing figure to see that the post-acquisition reserves balancing figure there is 53.91. And of course, the post-acquisition reserves are a very important element of how much of what consolidated reserves are consolidated from the subsidiary. We consolidate the group share of the post-acquisition reserves. Next up, we translate the income statement, and again we're given the income statement in zlotys, and all of the key line items translate at the average rate to give us an average rate translation of the profit after tax at $40.53 million. Now we can look at the consolidated reserves, and the consolidated reserves, as we've said earlier, is the group share of the post-acquisition reserves. And again, the group has a 75% holding, and the post-acquisition reserves have already been calculated from the translation of the statement of financial position, and 75% of those post-acquisition reserves now form part of the consolidated reserves of the group. Now we add to that the group share of the foreign exchange gain on goodwill, and you'll remember that when we translated goodwill, we saw the cumulative foreign exchange gain on goodwill was 0.6, and we, the group, now take our share of that into the group reserves of the Ravar group. So therefore, the consolidated reserves add to $40.88 million. Next, we look at the non-controlling interest. And again, the closing net assets we've already calculated in dollars are 69.86. Of course, the non-controlling interest own 25% of those net assets, because of course we, the group, we, the Ravar group, own 75%. So 25% of 69.86 is $17.46 million. But of course, the non-controlling interest also has goodwill, because it is the group's policy to value goodwill in the non-controlling interest. And if we go back to our goodwill calculation, we'd see that in zlotys, 2.75 million zlotys of goodwill are attached to the non-controlling interest. And when we translate that goodwill at the closing rate, it translates to $0.732 million, giving us a total non-controlling interest at the consolidated balance sheet date of $18.2 million. Thank you very much for watching this short tutorial from Question 5 Ravar from the November 2013 Paper 13 exam.